Okay, this is Order Flow Trading Course Lesson 17, Order Flow Continuation Setups. My name is Michael Valtos. I'm the founder of orderflows.com. Briefly, a quick disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 state hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, let's move on. Order flow continuation setups. This is lesson 17. The market spends a majority of the time trending from one price extreme to another. The big money is made in trends. You always hear about the trend followers, the turtle trend system. That's great, if you're a long-term trader, but, most people are shorter-term traders. They don't have the big capital behind them that, the big funds have that they can sit on a trend for 6 months. However, the good news is that trends appear intraday as well. When the market is in the middle of a big move, no one can tell you how long or how far it will go. What you want to know is whether it's going to continue or not. So whether it's a trend on a 1-minute chart or a trend on a daily chart or a monthly chart, you don't know when it's going to end, how far it's going to go. What you want to do is you want to identify that there is a trend and jump on board and try and catch your get your berries, get your grapes, pick your low-hanging fruit when it's happening. So in order flow, I have 4 continuation steps. It's really 3, but one's worded as 2. Basically, it's big fat market imbalance, stacked buying imbalance, or stacked selling imbalance, or what I like to call the 3 in a row. And I'll show you. It's easier to see it, I think, with photos. But quickly, I'll just explain it. A big fat market imbalance occurs when there is an oversized market imbalance. High volume levels are common at the beginning of moves and in the middle of moves, and bigger, well-funded institutional traders start to come into the market. So what that means is, a market has turned. Okay, it's reached its low or reached its high, and it's starting to move in the opposite direction. A reversal has started. And, the reversal is going to be this beginning of the trend. Well, how do you know the trend is starting to pick up steam? Is when you see, the big players come in and, build their position up, whether it's they're building their position up on the long side or the short side. Sometimes they get on board and you can see it really clearly in the order flow. You said in a normal bar chart, you wouldn't see it. But, for example, okay, so I like to think it's easier to explain things when you have a picture of a chart in front of you. So I'll talk about the big fat market imbalance. Now, when you're trading a market, you should know what's considered big volume, when it goes through. So you could determine if there's, institutional participation or not. So, for E-mini S&Ps, I tend to look at, volume between, 50 and 2,000 is kind of normal. Once you start getting above 2,500, to me that's really big size going through, at least the beginning of big size. And especially on a 5-range chart that moves very fast. If I'm seeing imbalances, if I'm seeing bars with volume over 2,500, I'm starting to pay attention because someone has got size. They're moving on both sides. To see a price level where you got over 2,000, 2,500, it's saying that, that even though there's an active buyer, there's still an active seller. Now, when I see an imbalance above 2,500, then I really stand and pay attention, and I usually take a trade. So here you see a big imbalance, 2,800. As the market's going up, you're not going to necessarily see that on a low of a move. You tend to find, the imbalance is going in your direction of the trend. Not necessarily, when you're going up, when, you want to see aggressive buying, you're not going to all of a sudden start go up, and on your move up, have aggressive selling, because there's going to be people bidding the market. There's going to be people buying the offer. Generally, on a move up, you're going to have people buying the offer being aggressive. That's why you should see buying imbalances. On a move down, you should be seeing selling imbalances. But when you see a number that really stands out here, 2,800, it's blue, it's a buying imbalance, it's against 480. It's telling me, there was some size there, but people were extremely aggressive and lifted the offer. It could have been one person, it could have been a couple people, who knows. But the fact is, it didn't spend much time, at these levels. It traded here, it went bid here, and traded higher. You get a selling imbalance up here of 2,000. Okay, it's big, but it's just sort of on the borderline of average to big. And it's not uncommon to get a selling imbalance just off of a high, especially in a red bar, because the market's going to go bid and it's going to trade back and forth. Lots of times you're going to get smaller volume traded right up on the high of a red bar. Just as, in a green candle, it's very common to get a buying imbalance on the second slot, just off the low. These are normal occurrences. Just like you have this buying imbalance here, you have the selling imbalance here. Here you have the selling imbalance. It's just sort of how the market trades. Oftentimes, I said at the bottom of a green candle, you tend to get smaller volume. So it's not uncommon to get the imbalance. Here you have the imbalance again. So I'm not too concerned with it, as opposed to when I see a big number sticking out in the middle. Okay, a stacked buying imbalance occurs when there's 3 or more buying imbalances in the bar stacked on top of each other. Stacked selling imbalance occurs when there are 3 or more selling imbalances in a bar stacked on top of each other. And, again, it's due to, the importance is it's due to above average volume, aggressive traders coming into the market to move it. The majority of the time it's one trader, but it can be several traders at the same time coming into the market to move it. Oftentimes what you're seeing is the result of a big order coming into the market that has to be executed as the market's moving. So what you have here, this is in the E-minis. This is at 7:20 in the morning, and you're seeing a stacked buying imbalance. You have 3 in a row right here. They're all stacked on top of each other. Here you have 4 in a row. And, you're looking for the market to continue in that trend. What you're seeing is, well, in this case, in times when there's, I'll say, is an illiquid time, but 7:20 in the morning tends to be lesser volume than 8:30 after 8:30 once the cash opens. But it's still important nevertheless. What you're seeing here is someone's got a big order they're trying to execute. They start buying some here. They're a little bit aggressive. You've seen the buying imbalances. The market never comes back. Then we start trading a little bit higher. Now they're getting more aggressive. Why is a stacked buying imbalance important? Well, the market's trading here at 1889. Someone's got, probably 1,005 to buy. They just go in. They know they're going to move the market a bit, but they want to get it done pretty quick. S&Ps is one of those markets where you can move, 1,000 and maybe move at a point. So, they're going to be aggressive and just go in and get it done. Now, the market will oftentimes squirt up a little bit, as other buyers come into the market saying, hey, we just rallied a point, I want to start buying. When the market retraces back into that zone of the buying imbalance, you're looking to see if there's going to be additional buyers in this area. That's when you're going to see a continuation of the move. If it's just a one-time order where, maybe someone was working against a basket of stocks or something and they just had to get it done and got it done, yeah, the market may trade sideways and then come off. But if it's a legitimate, if we're in a legitimate trend and the imbalance is legitimate, where it's just somebody, they want to build their position, oftentimes when you pull into the imbalance, it will trade around there and then continue on in its trend like you see here. Okay, oftentimes it takes a lot to get a market to move outside of a trading range and start a trend. Once the market starts a trend, the forces behind the move often appear in the order flow to confirm the move. Then you know that move will continue. So, like I said, it's one of those things, I hate to call it a self-fulfilling prophecy, but, when traders think the market's going to move, they're always talking to other people and trying to talk up their position, in hopes to get the market to continue. It doesn't always work that way, but, there's obviously big supply and demand factors in there. But once a trend starts, look for the order flow to confirm that the move has happened and get in and take advantage of that move. Okay, the next continuation setup is what I call the 3 in a row. The 3 in a row occurs when you have 3 ratios in a row in the same direction. Basically, you want to look to get in after the third bar that you see the ratio. Your entry could be anywhere between the point of control and the second and third bars. What it looks like is this. You have ratio, ratio, ratio. I'm not necessarily concerned about this buying imbalance. It's nice to see, but normally you don't get also a buying imbalance or a selling imbalance in your 3 in a row. What you're really concerned with is the ratios, and it doesn't have to be a ratio bounds low, small print, small print or anything like that. As long as there's 3 blue numbers, it could be single print, single print, single print. It can be large print, single print, small print. It doesn't really matter. What I'm really concerned about is having 3 ratios in a row. And, like this, I could just sort of walk you through it real quick. You have a ratio bounds low, so it's heavy volume down here, and the market starts rallying. You get a single print. It's the sellers in this bar are rejecting the lower prices. That's why you have the single print. Market goes higher. This one is technically a ratio bounds low, but it's close to a single print. But again, the sellers are rejecting the lower prices down here, and the market continues on higher. Really, what's important is have 1, 2, 3 blue numbers in a row, or on a down moving market, if they're up above the red bars. Where your point of entry is, it's somewhere between these 2 points of controls, between the third bar and the second bar. You want to get a little bit of a pullback for a better entry. There's going to be times where it just continues on and you miss your entry, but I prefer to have a little bit of wiggle room by getting a better entry rather than just paying the market. So a continuation pattern allows you to find an entry point in an existing trend. Trends are where the big money is made in trading, so it's to your benefit to jump in a trend. Some traders base their entire trading program on just jumping along for the ride. So it'll benefit you to have a few continuation pattern setups to look for. Like I said, some of these hedge funds and CTAs that have been around for 20, 30 years are trend followers. They're not trying to pick tops and bottoms. They just want to identify when a trend is occurring and ride it for as long as they can. These guys, that's why they trade, 50, 60 different markets around the world. They're looking for the 6 or 7 or 8 markets a year that have the monster trends where they're going to make up all their money. That's why, they're willing to take a bunch of small losses, but their winners is going to be quite big. So when a trend is underway and there's a pattern telling you to buy, you buy. Just as if the market is telling you to sell, you sell. Especially in a trend, you want to ride the trend because, when the market moves from a low to a high and you're not in on it, you feel like an idiot. But, you still need a reason to get into the trade. Alright, so let's take a look at a chart. Here you have a bond chart. We came into the low at 11.45. You have the single print. And then, 30 minutes later, you have another single print. So now you're sort of convinced yourself that the trend is up, alright, that we're starting to move away. Where's your continuation pattern? You come back down to the same level, it holds. Then you're starting to see, as you're moving up, you're starting to see confirmation with single print, and the market moves higher. This one's a little bit more messy, but nevertheless, I'll talk about it. We sort of peaked up here at 10.18, in the bonds and start coming down. You have a ratio here of 0.53, then the market proceeds to go sideways. Now, I know the high is here, and what's happening is you're starting to get a couple ratios here, a couple ratios here. It's kind of hard to really get a good gauge on which way the market's going to go. So what I'm looking at is where the points of controls are. Now, I know the points of control here, here, here. I had talked about earlier, using point of controls as support or resistance. So in this case, I think the market is in a downtrend because, I know we have a high here and I see this ratio bounds low. Even though you have a single print here, a large print here, but you have opposing single prints just on the other side of these two. But what's interesting is you have the points of controls all lining up right here. So now I'm not too concerned about these, because this one still has a negative delta, this one has a small positive delta. If I'm expecting the market to really move higher, I want to see a strong positive delta. So, I'm able to take this ratio, this ratio, this ratio more seriously than these two. In fact, I got the points of controls here. I'm still looking for a downtrend. I'm still looking for the market to move lower. And then I'm seeing a few more confirmation ratios here. Ratio bounds low and a single print. So it's telling me, the move should be lower. Again, this is the bond, and you hit the high, and we start working our way down. You're seeing the single prints here with nice ratios, 77, 82, and you're thinking already the trend is lower. Maybe you're not convinced yet. You want a little bit extra. But, you're seeing the selling imbalances, selling imbalance, selling imbalance, selling imbalance, selling imbalance. If you're still not convinced, this bar here has got a very strong negative delta. And then immediately it's followed by a bar with a single print. So it's telling you, it said you should have been alert way up here, but, we're in the trend already. So you're looking for a sign of continuation. You're seeing a delta very strong. You're seeing a lot of selling imbalances. You're seeing the single print to help confirm the ratio. Help confirm the move lower. Okay, now this is an E-mini chart. Now, we've come down into our low here. We got a buying imbalance right on the low. Okay, maybe you're not yet convinced that this is the low. You want to see the trend start to happen before getting in. And boom, you get this other ratio bounds low here, indicating some stopping volume. And you get another buying imbalance, and the market worked its way back up. Okay, S&Ps again, we're working our way lower. We got a ratio bounds low, some heavy volume here. We got a single print. You get a pullback up to the single print. Okay, you're working your way lower. You get a pullback. You say, well, I'm not sure if this is a pullback or we're just going to go higher. So you want to have some extra confirmation. Now you have it. You have the selling imbalance and the market sells off. This by itself, where we trace back up to the single print, for me is normally a good trade. I like it when the market circles back up to a single print, to get short. Then when I see a selling imbalance, then it tells me to hold on to the trade a bit longer. Okay, so we're working our way up. Nice, ratios here, blueprints. It's telling you we're in a trend already. You really should have been looking to get long in here. Say you missed it. You're looking for another reason to get long, that the trend is going to keep continuing. And what you have, you got buying imbalance here. I'm usually not a big person to get long in a buying imbalance, but this is one of those cases where if you have a tight stop, I usually like to get long in a buying imbalance. I'd prefer to get a little bit lower though. But if you have a tight stop, you can manage it. And, it's going to give you a chance to get back in on the move back up. Like I said, you have this high here with the ratio single print sort of standing in your way. But you know what? If you're able to get in somewhere down here, your risk is relatively low. Because usually I like to see a pullback up to this level. So, if you're going to get a pullback up to that level, you have a chance to get past it. Sometimes it's hard to sell a high. Just off of a single print and a ratio and negative delta. But, there are times when it doesn't work. And, if you're looking for a continuation of a trend, then it's going to happen. That one made no sense. Okay, now what do you have here? You got an E-mini chart. Market's coming down, down, down. You got a couple selling imbalances right in a row. Now I like this, where you get two selling imbalances split over 2 bars. You get to pull back up here in a single print, and then the market sells off. When you're seeing selling imbalances, going into a low, you might want to be careful, but if you get a pullback in there, it's telling you that these most likely are going to hold and the market's going to continue lower. Again, we had sort of coming off our high up here. We got a selling imbalance. Then you're seeing the confirmation with the ratios, the blue numbers, as the market's moving lower. So this is the end of lesson 17, continuation setups. In the next lesson, I'll explain how to integrate order flow with your traditional technical analysis to enhance your current ways of trading. I didn't spend much time under continuation setups because it should be pretty easy for you to spot. I gave you a few setups that I like to look for, but in general, you're still looking for the same things that you're looking for around reversals. With continuations, it's generally because you missed the reversal sign and you're getting in just a little bit late on the continuation. But you should always be looking for any setups where they're occurring. Just take them into context with where the market is. If the market is trending, it's okay to take the setups. If the market is going sideways, I'm a bit hesitant to take setups. I said I want a market to be moving, not basically spinning its wheels. When a market's moving is when you're going to have the opportunity to make money. So the important thing is, just be able to determine when the market is moving, and if you're seeing a setup, take it. If the market is not moving and you see a setup, be hesitant. So thank you. That's the end of lesson 17.